Hey everyone, today we're going to get right to the heart of what makes Bitcoin, well, Bitcoin. Before all the hype and the headlines, there was this single massive technical problem that nobody could crack in a decentralized way. And that was, how do you stop people from spending the same digital money twice? It's called the double spending problem. And honestly, solving it was the breakthrough that changed everything.
And it all really starts with this idea from Bitcoin's anonymous creator, Satoshi Nakamoto. This quote is everything. The idea that the real problem with our money isn't the money itself, but the trust we're forced to place in institutions to make it work. That's the key that unlocks this whole thing.
Okay, so first up, let's talk about that problem with digital trust. See, in the real world, if I have a dollar bill, it's simple. But online, we've always needed a middleman, a trusted third party to make sure all the numbers add up. I mean, just look at the difference here. On one side, you've got physical cash. You hand it over, that's it. The deal is done, it's direct, it's final, no one else is involved. But on the other side, online payments. Every single time you buy something, there's a bank or a credit card company sitting right in the middle, verifying it, processing it. You see, we're basically forced to trust them to handle our money. And this is exactly what Satoshi was getting at. This trust model has what he called inherent weaknesses. Those middlemen charge fees, which drives up costs for everyone. And because they can reverse transactions to handle disputes, businesses have to live with this constant threat of fraud. It also makes really small, casual payments, like tipping someone a few cents for an article, pretty much impossible. And maybe worst of all, we have to hand over so much of our personal data just to prove we are who we say we are. All right, so looking at all these problems, Satoshi posed this, honestly, a radical question. It was a puzzle that computer scientists had been banging their heads against for decades. How in the world do you create a pure form of digital cash? What if you could just send money online directly from me to you, with no bank in the middle? A purely peer-to-peer version of electronic cash, money that acts just like physical cash, but for the internet. A system that's built on cold, hard, cryptographic proof instead of just trust. So the idea was this: a peer-to-peer network. Instead of one central bank holding the one true list of every transaction, what if everybody on the network held a copy of that list? In this kind of system, every single user helps keep the network honest and secure. There's no single point of control and no single point of failure. But, this whole idea hits a brick wall, a huge one. It's the villain that has haunted every attempt to create digital cash. And it's the very reason we've always needed banks in the first place. It's the double spending problem. I mean, think about it, right? Anything digital, a photo, a song, a document, you can copy it perfectly a million times over. So if a digital coin is just a piece of data, what's to stop me from sending that same digital coin to Bob and then turning right around and sending the exact same data to Charlie? Without a bank in the middle to say, hey, you already spent that. How do you solve this? Okay, let's walk through exactly how this kind of heist, called a race attack, would work. First, Alice sends one Bitcoin to Bob to buy something. Bob sees the transaction pop up on the network and he hands over the product. But at the exact same moment, Alice secretly broadcasts a second, conflicting transaction. This one sends that very same Bitcoin right back to her own wallet, but she attaches a higher transaction fee. Now, the people processing transactions, the miners, see two versions. And since they're paid in fees, they're financially incentivized to confirm the one that pays them more, Alice's. As soon as they do, Bob's transaction is kicked out of the system. It's invalid. He's lost his product and he's lost the money. So how do you beat this? Well, Satoshi's genius wasn't inventing one single new thing. Instead, he took three existing ideas from computer science and wove them together into this ingenious system, a toolkit for building trust where there was none before. First piece of the puzzle, digital signatures. This solves the problem of ownership. It's a bit of cryptographic magic that lets you prove you own a specific Bitcoin so you can spend it. Think of it like a signature on a check that is mathematically impossible to forge. And this is basically how it works. Without getting too bogged down in the math, you have a secret private key that only you know. You use that to sign a transaction. Then anyone on the planet can use your public key, which is safe to share, to verify that your signature is legit. It proves the transaction came from you and only you, all without you ever having to reveal your secret password. That's how ownership is secured. Okay, so that proves who owns the money, but it doesn't solve the order of things, which is the key to stopping double spending. The second tool is a kind of public timestamp server. Basically, the network gathers up recent transactions into a block, stamps it with the time, and then chains that block to the one before it, creating a public chronological history of every transaction. And that, well, that's the blockchain.
Right, but what stops someone from just rewriting that history? This is where the real magic comes in, the third and most brilliant part of the toolkit, proof of work. To get the right to add the next block to the chain, miners have to solve this incredibly difficult computational puzzle. It's specifically designed to be so hard that it takes a massive amount of real-world computer power and electricity to solve. It literally anchors the digital blockchain to physical, real-world costs.
Satoshi had this brilliant way of putting it. He said proof of work is basically one CPU, one vote. Instead of voting based on who you are, which can be faked, the network votes with raw computational power. And the version of the history, the blockchain, that has the most computational work poured into it is accepted by everyone as the one true, honest version. Okay, so let's put it all together. How does a transaction actually get through this system? First, new transactions get broadcast out to everyone on the network. Second, the miners start collecting these transactions into a new block. Third, they all start racing, burning electricity to solve that block's proof of work puzzle. When one miner finally finds a solution, they broadcast their winning block to the entire network. Fifth, all the other computers check the block, make sure all the signatures are valid and no one's double spending. And if it's all good, they accept it. And here's the crucial last step. They take the unique fingerprint, the hash, of that block they just added and use it as the foundation for the next block they start working on. And that's what creates the secure, unbreakable chain. And this is the real breakthrough. This is the aha moment. If an attacker wanted to go back and change an old transaction to double spend that money, they wouldn't just have to resolve the puzzle for that one block. They'd have to resolve it for that block and for every single block that has been added on top of it since, all while the rest of the world's honest miners are still chugging along, extending the chain even further. It's a computational race against the entire global network, a race that becomes practically impossible to win the deeper you try to go into the chain's history. So, after all that, did it actually work? What is the legacy of this wild and brilliant solution to the double spending problem? Well, this number pretty much says it all. 0. That's the number of confirmed malicious double spends that have ever succeeded on the main Bitcoin network in its entire history. The security model, against all odds, has held. Now, that's not to say it's perfect. Far from it. There are some really big, valid criticisms. The very same proof of work that makes it secure uses an enormous amount of energy. The price is famously volatile, and when the network gets busy, transaction fees can get really high. Its pseudo-anonymous nature has, of course, been used for illicit activities. And if you lose your private key, that's it. Your money is just gone. But, the story doesn't just stop there. The tech is always evolving. To tackle problems like speed and cost for everyday payments, new layers are being built on top of Bitcoin, like the Lightning Network. It creates these little payment channels that let people send tiny, instant transactions back and forth for almost no cost. So in the end, Satoshi's system was this incredibly elegant solution to a problem people thought was unsolvable. It gave the world its first truly scarce digital object. It proved we can transact without a central authority. But it leaves us all with an even bigger, more profound question. What does a future built on cryptographic proof rather than institutional trust really look like?